Ugh, our health insurance bill is going up again. For what we pay every year, we could add another room onto the house.
Sheesh, you're right. It seems like we're paying more and more for a service we barely use. I mean, I do yoga and eat all my veggies, and we hardly ever get sick.
Now that we're no longer required to purchase health insurance, it makes me wonder, should we be paying for it at all?
We could pocket the premiums ourselves, and if we get sick or hurt down the line, we can just use that money to pay the bill.
But what if we have a serious injury, like your turkey fryer incident last Thanksgiving?
No sweat. We can just crowdsource money for the bills. I see people on Facebook fundraising for medical costs all the time.
Great. Although I do think you should quit your extreme parkour.
Only if you quit knife juggling.
Deal.
Found yourself wondering if you should just skip out on this whole health insurance thing. If you don't have coverage offered through your job, it's a pretty hefty monthly expense. In 2018, the average private insurance plan cost $440 a month for an individual and $1,168 for family coverage. For that kind of dough, I could afford that trip to Japan or buy a miniature pig.
With the recent repeal of the individual mandate within the Affordable Care Act, some younger, healthier people might be left wondering, should I pay thousands of dollars each year for a service I'll probably never use?
Take Maria here. She just graduated with a master's degree and works for a tech startup that doesn't offer health insurance or retirement options. She's making too much to qualify for subsidized health care, so she has to pay $375 a month for her individual health insurance policy. But she's an avid runner, eats mostly organic, and hasn't been sick in 5 years. That money could be going to her retirement or savings to buy a house. What might happen to Maria if she decides to cancel her policy in order to fast-track other financial priorities?
I think it's time to
run the numbers.
If Maria decides to cancel her health insurance policy, she can expect to save around $4,500 a year. But she'll still prepare for the occasional minor injury or illness by setting aside $1,000 a year for doctor visits or occasional urgent care. If she stashes what's left in a CD earning 2.5% interest in just 5 years, she'll have $18,857. Maria just has to stay relatively healthy for the next 5 years, and she's gamed the system.
Things are going fine for a while. And then, in her 3rd year of the plan, Maria is in a serious car accident. Auto insurance would only pay a fraction of her medical costs. And after all the hospital, surgery, and ambulance bills, Maria is left with $58,000 in medical debt and an additional $8,000 on credit cards she used to pay her bills while recovering. Desperate, Maria launches a GoFundMe campaign, joining the 250,000 other people who use the platform every year to try and help pay medical bills. And she ends up raising the average amount, only $3,000.
Facing $63,000 in debt, her parents decide to help. They take out a line of credit on their home, using the money to pay off Maria's debts in full. 2 years later, when Maria's dad is forced to retire because of his own health problems, they fall behind on their mortgage payments and lose the house.
Granted, the chances of a sudden, costly medical problem hitting someone young and healthy like Maria are slim, but not insignificant. A 2011 survey found that people between the ages of 25 and 34 had a 1 in 10 chance of getting hit with a medical bill of $13,000 or more, and a 1 in 20 chance of at least a $27,000 bill.
Considering the lifetime of financial damage that kind of price tag can do to you or your family, these odds are not to be taken lightly. Besides, the whole point of insurance is to protect you from really bad things that probably won't happen. No one buys insurance hoping they'll get to use it.
Is there a middle path that Maria could have taken that would have allowed her to save something, but also be protected against a catastrophe? Well, she could have enrolled in a high-deductible health plan. These have lower premiums and will help you if something really bad happens, but don't typically cover routine medical costs. Most insurance providers offer such options, and they can be a good fit for young, healthy people.
But Maria would still be on the hook for everyday doctor's visits and medication, so she could set aside $1,000 a year for that purpose, but put it into a health savings account, which allows her to deduct the money from her taxes. And anything that's that's not used for medical expenses becomes part of her retirement savings. Health savings accounts are available only to people with high-deductible health plans and can be started at your insurance provider's recommended bank or one of your own choosing.
Imagine if Maria got into that car accident with this scenario. The most she'd have to pay out of pocket is $4,000. And if she stays safe and healthy, she'll be stashing money away into her HSA that could later be used for retirement, and even have a little left over to start saving for a home.
Most importantly, she knows she's not putting her financial future or that of her loved ones in jeopardy.
And that's our 2 cents.
Do you know other creative solutions to the high costs of health insurance? Let us know about them in the comments.